Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 315 of the Independent Advisors Podcast. On today's show, we're covering a few timely yet important topics, including not chasing the next big thing, alternative investments in 401ks, consumer confidence, Buffett cash levels, the housing market, and insider stock purchases. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So let's jump right in. How are you doing this afternoon, Matt?
I'm doing great, man. I'm doing great.
Yeah, a lot going on.
Kids are back to school.
Mm-hmm. Weather, at least for right now, is a little cooler than it has been here, which is nice. But yeah, that's the sign of kids going back to school, right?
It is
getting to fall, and are the kids happy about going back to school? Or
what I was gonna say is my wife and I are very pleased at how easy it was to get back into the routine this year. To the point where I'm kind of keeping a close eye over my shoulder. I'm like waiting for something, but so far, this is where I would normally address you as Uncle Mark to the kids. Uncle Mark, things are looking very promising.
Yeah, that's good. Well, it's nice that Oakwood eases the kids into it, because I think Micah and Evie started on a Friday, so they just had one day.
Yeah, it's like a holiday cameo.
Yeah,
right?
It's great. It's great. Just ease your way right into the new school year. So
yeah, that's smart.
Yeah, very, very smart.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Well, we're just going to hop right into it, Matt, this week and talk about some tweets, articles, and research from the past few weeks. So the first thing that I had was a post on X from Frank Capillari, and this was back on August 11th. He says, MSOS, the big question. Is this the beginning or the end of the move? And the ticker symbol, what he is referring to, Matt, the MSOS, is the Advisor Shares Pure U.S. Cannabis ETF. And he posted a chart about this ETF, and it shows this pretty large downtrend. And he thinks that this could possibly be a changing trend and turning into an uptrend. But that's not really the reason why I brought this up, not for cannabis ETF specifically, but I think that this is just a great example of not chasing, quote, the next big thing that everyone's excited about. I remember, back several years ago when marijuana was being legalized recreationally in several states, and everyone thought that these, again, quote, pot stocks were going to take off. And the reality of it is that the industry got demolished for several years. And in fact, I remember me and you were on a business trip in Florida, and we were just in the hotel one night, and we were looking at these stocks, and we were like, wow, like how is, Tilray, for example, up 300% in a couple month period.
That brings me back.
And, everyone was coming to us and saying, hey, is this something that we should be adding to our portfolio? And the advice that we gave at the time is the same advice that we've given on this podcast before, is that if your friends are telling you how much money they've made on XYZ investment, it's usually probably too late. But then also, they're telling you they're good investments and not their bad investments that they've lost money on, right? So I think that, the marijuana craze that happened several years ago is just a really, really good example where people thought, it was going to take over the world from a stock market return standpoint. And we've seen a bunch of these cannabis names go out of business, number one, get cut in half and be down 80, 90, 95, 98%.
Yes.
So I think you just got to be really careful when you start to hear things like this is the next big thing. And in this case, it was, using cannabis as an example, but anything else you want to add to that?
No, I think you gave kind of the next big thing. I mean, I love talking about this topic because that's only going to continue to happen. One could sit there and argue that on the fringes of the AI trade, you got some really speculative things that are being discussed, things like quantum computing. You get all these different kind of subsectors of the AI trade that people are getting excited about. And it always kind of brings me back to my roots. A lot of the enthusiasm can happen, but at a certain point, you got to make money. You can only bleed money and raise money for so long before it kind of hits brass tacks. You got to be profitable.
Yeah.
And look what happened to a lot of the marijuana-related stocks. My second thing is for our viewers and listeners, if you wonder what Mark and I do on these business trips, yes, we constantly look at stock charts and we talk about the market while watching things like football. It constantly happens.
Yeah.
We never stop talking about this stuff.
I, for whatever reason, I vividly remember us sitting in the hotel and
I
talking.
think we were watching a football game too.
Yeah, and we were just like, wow, it just doesn't make a whole lot of sense to us as to why some of these names are up as much as they were. But
we get our money's worth out of these charting subscriptions.
Yeah, for sure. And we definitely saw their fall from grace, and most of those names have not recovered or have even come close to recovering.
Well, just remember, over the years and decades, there was the oil stocks that were hot, and then it was the gold stocks, and then you had the pot stocks, and it's like
green energy stocks.
I mean, keep going down the list of like all the different investment fads that have come and gone. And again, usually when the old school version was when your cab driver's talking about it, it's reached a peak.
Right, exactly.
Right. And lastly, just from a compliance perspective, no recommendation for or against any of those securities. But I do love that you had this illustration in general. Great job on that one, Mark.
Yeah, so the next thing I had was another post on X from Jay Capel, and he works with Sentiment Trader. This was back on August 15th. He says, as a student of sentiment, I love, in all caps, low consumer confidence numbers. I wouldn't call it a buy signal or even necessarily bullish in the short term, but the University of Michigan consumer confidence values below 59 are definitely not bearish for stocks. Taking a term out of your vocabulary, which is great. But essentially what this chart shows, and it'll be on the YouTube page for viewers and in the show notes for listeners, it shows a chart of the University of Michigan Consumer Confidence Survey. That line is in blue. S&P 500 is just above that in black. And what this shows is that when confidence gets pretty bearish, or below 59 in this case, because this ranges from this indicator, the U of M consumer confidence ranges from 0 to 100, or actually larger than 100. And the higher it is, the more bullish people are. The lower it is, people are a little more pessimistic on the outlook of the stock market and the economy.
In personal finances, et cetera.
Yeah. So what this shows is that, Jay is considering the level of 59 to be pessimistic confidence.
Kind of his over-under per se.
Right. So this back test goes all the way back to, it looks like the 1960s, and 12 months after the U of M consumer confidence number falls below 59, stocks are higher 94% of the time 1 year later, for an average of 17%. And then you look at 2 years out, stocks are up on average 31%, positive 88% of the time. And then if you look at it kind of on a shorter term basis, 6 months out, stocks are up almost 10.5% and higher 76% of the time. So I know at least I read, Matt, a lot of research and articles that reference this consumer confidence indicator. And they say when people get bearish or pessimistic or have a negative outlook that we're usually around a peak for stocks, right? And I just thought that it was interesting that Jay presented some hard data and not an opinion to kind of contradict that narrative that I think is out there a lot of the times.
I think this is timely. I think that there is some pessimism building up in the market right now on a stock market sentiment survey, which I've talked about in the podcast recently from the American Association of Individual Investors, which is the AAII. Say that 10 times fast. You're indicating now that you have more bearishness than bullishness in that sentiment survey. But look at where the market's at right now. And I'm going to agree with you on this from a stock market perspective. For a 6, 12, 18, 24-month time horizon, that gets me excited. I like the contrarian aspect of this.
Yeah, I do too. So I thought that
Good
was
job highlighting
a nice piece. And even though, we're right around, give or take a couple of percentage points, all-time highs, depending on what index you look at, interesting that there's so many people that are pretty negative on the future.
Yeah. Interesting.
Yeah.
Interesting. Right. Here's one I got for viewers and listeners. I was listening to the morning show that All Star Charts puts on. JC Peretz, friend of the podcast. We've had him on a couple of times. They were talking about over the past week Berkshire Hathaway. And the roundtable came up in the talk show in regards to when Buffett really started raising cash a couple of years ago. What were all the initial headlines? The headlines were this: you should be concerned that Buffett's raising cash. When Buffett raises cash, that means fill in the blank, right? So the latest narrative you're seeing about Buffett is what are some of the cash levels and where they've been with the parent company, Berkshire Hathaway. Again, not a recommendation for or against Warren Buffett's conglomerate, but I do think this is an important illustration. So when you look at their cash build, the data set on this is going to be February of this year, but it gives a good illustrative purpose. In 2020, they had $140 billion of cash on the balance sheet. Beginning this year, they were over $300 billion, over 330 to be exact. So the narrative in the marketplace is if Uncle Warren's concerned about the market and raising cash, you should be too. And what's happened the last couple of years? Yeah. We've had corrections here or there, and a good one we had in February through April, but for the most part, the market's higher. The point that they were making on the morning show, which I found really interesting, is even though that cash level has builded tremendously the last 5+ years, what is that cash level representative of the stock's market cap? So this chart, this illustration will be put up by Jenna for our YouTube viewers. This will be in our show notes, and I'll verbalize it. The percentage of market cap of how much of it is in cash at Berkshire Hathaway peaked in 2019, and it peaked at above 30% of its market cap. It's now sitting at 21%. I just want to throw it out there that this kind of reminds me when I see the financial news media throw out things such as credit card debt is ballooning. It's never been this high. Well, give it to me as a portion of income, right? And all of a sudden the numbers don't look so bad. Or credit card debt is up X in the last 12 months. Yeah, show me a chart that goes back 10 years. And I just think it's an interesting way to look at the math. It's easy to get the headlines with Buffett has this much in cash. It's a little different when you start looking at it through a market cap lens. Found it interesting. Mark, your thoughts?
Yeah, I think, looking at this record cash build, as they say, I mean, since 2015, every single year, their cash pile has gotten larger and larger. And, it'd be interesting to find out exactly what the S&P 500 did from 2015 until now, but I can tell you it's up a lot.
It's
right?
It's a hot take, and I'm here for it.
So it's one of those things. It's a financial news media headline grabber to get clicks and to get attention. But the reality of it is, Warren Buffett and Berkshire don't have the same goals and objectives that our clients have, or that anyone that is listening to this has.
Well said.
And there's a lot of different reasons why there could be, a significant cash raise like this. It's not just because people are Warren and Berkshire and the people that are calling the shots there are nervous about the future.
Well said. That was well done on your part. TED Talk there by Mark McEvely. My next item is a wild chart about housing. This is a post from Nick Gurley, and the timestamp on this, Mr. McEvely, is August 18th. And what this chart is overlaying is the median sales price of the average new home in America versus existing home prices. And historically, as most of our listeners and viewers will immediately think, is that typically existing homes are cheaper than a new build, right? So what this chart is showing is that for the first time ever, it is considered cheaper to buy a new home than buy an existing home. I thought this was really interesting, and it caught my eye. The chart will be in our show notes if you're curious. Jenna will put it up for our YouTube viewers. But let me dig here as to some of the underlying data that Nick posted, and you and I can have just a real quick roundtable. He said in June 2025, it was roughly 8%, or $33,500 cheaper to buy a new home from a builder than buying an existing house. Wow, it's pretty big stat. And one thing I found interesting when you dig a little deeper is, what's happening here, he says, that builders are adjusting the realities of the current housing market. They've cut prices. This is according to Nick. I don't have the underlying source. They've cut prices 13% from the peak and are giving generous mortgage rate buy downs on top of that. I've heard about that. And they're also building slightly smaller floor plans, all in an effort to deliver affordability to buyers. And so I'm curious when I kind of see this data point, Mark, what goes through your head?
Yeah, I think, it's something that we've talked about a lot here, that we've always been, not always, but it seems like for the past several years, we've always been in this situation where there just is not enough housing for people in this country, right? Mm-hmm. And I think, when you see something like this, or at least for me, like, when I was younger, when I bought my first house, like that was always the goal, right? Is to buy a new house or build it yourself, customize it. And I think it just goes to show you like where people are with their income and with the economy today, is that they don't necessarily care if it's new. They want to buy something that fits their family needs or their personal needs. And if that's a used house, then that's going to be a used house. But I don't, I guess, totally know or understand why this is the case, other than, we've shared data here before over the past couple of years that home builders are ramping up supply. And obviously, as we know, with more supply on the market and not really a change in the demand, prices are going to come down, right? Yeah. So that could be a simple enough reason as to why this is happening. But nonetheless, it is very, very interesting to see this, because we haven't seen new home prices on average be cheaper than existing home prices, going all the way back to the late 1990s, it looks like.
Yeah, because I want to make sure I use my language right. The post said, and I want to make it very clear, it is considerably cheaper to buy a new house than buy an existing home. He said, and I quote, "For the first time ever, it is considerably cheaper." I think the difference in prices, it was 2005, it was 1.4% cheaper. Now it's 8%.
Yeah.
Drastic difference.
So like I said, I mean, it's been talked about in the financial news media for the past decade or 2 decades that there's just a shortage of new houses, and these builders aren't building fast enough to keep up with the demand. And now they finally are, after ramping up, like kind of post-COVID, I would say, is when that started happening. And now you're seeing prices come down. It's just the perfect example of supply and demand, baby.
That's well said. And I think, why is this relational to the stock market? I think it's relational to consumer confidence, to a lesser extent, investor confidence. You know, someone's home for the average American, that is either the or one of the largest investments that an American has if they own a home. And not that the average American is tapping into their equity. It's more of a psychological effect that it plays. And let's face it, you know, home prices the past 5 years on average are up considerably. And I'll be curious to see the trajectory of interest rates, if that gets things going again from an affordability standpoint in these mortgages, Mark. But, you know, if we start to see some broader weakness in prices, that's where, as an equity investor, you got to stay attuned to how that could affect the psyche of the American consumer.
Yeah, and I think the other thing to point out, you know, not trying to be on one side or the other of the political aisle, but I think this might be surprising to a lot of people with the tariffs announcements that the administration has come into place. And I know that a lot of those tariffs have been delayed or reduced or whatever, but I think when those tariffs were first announced, people were worried that by the time we get to August or September of this year, that prices for everything were going to be so much more expensive, and we just simply have not seen that yet. And maybe that does come home to roost sometime in 2026 if none of these longer term trade deals get across the finish line. And then maybe a lot of these tariffs that were announced go into place for the long term. But at least right now, you know, we're seeing it in the CPI numbers. It's just prices are not as high as what people had initially expected back in April of this year.
Well said. And I just pulled up lumber as you were speaking, talking about you and I and our charting skills. You're drastically more dangerous than me. But the price of lumber is lower than what it was during all the tariff hysteria back in February and April. It's lower now.
Yeah. So obviously that stuff can change pretty quickly, but it is interesting to see things, you know, cheaper than people expect. And again, what does it go back to? It goes back to when everyone's on one side of the aisle and thinks that X is going to happen, a lot of the times Y happens. And that's what's going on here.
Love that. My last piece I have before we invite Taylor Ledbetter on the podcast is a quick stat on insider buying. I saw this, the underlying source of this is Barron's, produces this every week. This is a post by the good old Wall Street Jesus.
Wall Street Jesus.
Wall Street Jesus. He's a very popular trader on X. Posted this on August 16th. But the reason I'm bringing it up is you saw all the headlines in the month of July about all this insider selling, Mark, and how bearish that is. And, you know, all of a sudden, buying comes back into the fold, and it's crickets. You don't hear anything about it. Mm-hmm. And, you know, that is, I highlight this because I want listeners and viewers to be challenging, you know, some of those narratives that are out there, you know, because remember, at the end of the day, there's two guiding emotions in investing: fear and greed. And, you know, fear has definitely been in vogue the last 5+ years, it feels like, in the broader financial news media. And when you see some more of these bullish indicators, they tend to get ignored. Your thoughts, Mark?
Yeah, no, I've been reading similar research on insider buying and 13F filings, and you know, figuring out what all the large institutions are buying. And it seems like, for the most part, this is a blanket statement, it's not for every stock out there, but for the most part, there has been a lot of insider buying that we've seen.
Yeah.
You know, I get subscribed to a newsletter that tracks this stuff on a daily and weekly basis, and we're not talking about small chump change buying.
We're talking about a $3,000 trade here.
No, I'm talking about a $3 million trade or a $10 million trade that we've seen some of these insiders, whether that be the CEO, the CFO, the COO, chairman of the board, people are leaning into some of this weakness that whatever stock that they work for, whatever company that they work for, they're leaning into the weakness in the stock because they're so confident of what's going to happen over the next 12 to 18 months. And, this is something, again, going back to Sentiment Trader, it's a research service that we subscribe to, and they've been saying the same thing, especially in technology, consumer discretionary, healthcare has peaked up with insider buys. So, again, a lot of these people are pretty smart, and they're not buying their own company stock to lose money. There's a reason why they're putting their money to work in such large sums. And I'll tell you one thing, it's not to lose money.
Well said. I mean, I'm going to do a classic Mark McEvely quote for our longtime listeners. And I quote, "There could be a lot of reasons why insiders sell their company stock, but there's typically only one reason why they buy it."
Yeah, it gets going up, man. It gets going up.
Classic Mark McEvely.
Appreciate it.
All right, well, we're going to transition. Anything you want to leave our listeners and viewers with before we have Taylor onto the podcast?
No, I don't think so. Kind of quiet in terms of news stuff going on. We'll have Fed announcement next month. Earnings season has pretty much wrapped up for the most part. So I think I'll leave it there for the day.
Sounds great. Thank you, Mark. So on to the podcast is going to be Taylor Ledbetter. She heads up financial planning here at Jessup Wealth Management. As we mentioned on some previous podcasts, she has a blog, an active blog on the Jessup Wealth Management website. She posts regular, fresh, relevant content to that blog. Taylor, welcome to the podcast. How are you?
I'm doing good. How are you?
Doing great. So I know you always come with fresh content, content that is maybe kind of news breaking or latest news. So what do you have this week for listeners and viewers that's relevant to what's going on today?
Mm-hmm. Yeah, so today I wanted to talk about a executive order that was signed on August 7th by Donald Trump.
Okay.
Basically, this order is allowing for alternative investments and 401ks.
That's a big headline and a big order.
Yeah, I think so too, because, we don't see this right now.
This is really interesting to me.
Mm-hmm.
I've just scratched the surface on this topic, so you're even going to educate me a little bit on this. So let's see what you got on this.
Yeah, well, first I want to go over specifically what's included in that alternative asset or investment term.
I like this idea.
So this comes straight from the White House's website. So this is what is hopefully going to be allowed in 401ks in the future.
All right.
So first we have private market instruments, including direct and indirect interest in equity, debt, or other financial instruments that are not traded on public exchanges.
Interesting.
So an example of this type of investment is maybe a company that buys or invests in another company that is struggling or wanting to grow or restructure. And then that's where your return comes from, that professional fund manager.
Interesting.
Next, we have direct and indirect interests in real estate, including debt instruments secured by direct or indirect interest in real estate. So these would just be like real estate mutual funds, index funds, or ETFs.
Okay.
Next, holdings in actively managed investment vehicles that include digital assets. So I think cryptocurrency.
Got it.
Direct and indirect investments in commodities. So these are things like agricultural products, raw materials. They have like commodity focused EFTs and different types of index funds for this as well.
Yeah, when I got started in the industry, what the hot trade was for private stuff were CTAs, or commodity trading advisors, were really popular in the late 90s.
Mm-hmm.
Yep,
that's a perfect example. They also mentioned interest in projects financing infrastructure developments.
Interesting.
So things like working on roads and bridges, airports.
And on the private side, interesting.
And the last one that was listed was lifetime income investment strategies, including longevity risk sharing pools.
Interesting. Sounds very insurance, big insurance company type stuff, right?
Yes, yes. And historically, I think that these types of investments haven't been offered for a few different reasons.
In like retirement plans like 401ks?
Yes.
Okay.
Well, a lot of times with 401ks, participants are kind of on their own with picking out investments.
Yep.
They, don't really have help from an advisor.
Yeah.
But these types of alternative investments, they're very high risk.
Yes.
They're very complex. I feel like, the average person.
Check and check so far.
Yeah, most people probably haven't even heard of these types of investments. They're obviously not very liquid. There's a lack of transparency as well because you don't maybe know what the holding period is going to be for these specific investments.
Sure.
So that also makes it hard to value, what you're buying.
Yes.
And fees can be a little bit higher for these types of investments compared to traditional mutual funds.
You're hitting the nail on the head.
But what I wonder is how ERISA is going to play into all of this. I think I didn't see a date for when these investments are going to start being offered to plans.
Okay.
I think it's going to be in review for a while.
I would argue that too. When I see this stuff, the first thing that comes to mind beyond the level of risk, the biggie for me is just the lack of liquidity. So what investors got to understand when they want to consider these types of things is anything that's not publicly traded, you are beholden to some sort of liquidity schedule. I have seen over my decades of experience, Taylor, prospective clients and current clients come to me after they had purchased something like this. And they're like, Matt, I've been in this for fill in the blank 5 years, 8 years, 10 years. I have no idea when I'm going to get my money out. I've inquired. And when you kind of read the fine print, it's kind of up to that manager to have a lot of latitude on those topics. And when you're tying up, significant portions of someone's 401k, at some point, they're going to retire. And at some point, they're going to want some income from the portfolio, the average, right? American, right? And if you're got the money tied up and the manager is like, well, Taylor, I know you invested with me, but sorry for your luck. We're not going to have liquidity for at least another fill in the blank 3 years. That's tough. So it might be a hot take. But when I saw that, I'm like, oof. That I think it's going to do more harm than good to the average investor, if that makes sense. Going back to your ERISA comment, if I had to be someone who forecasts how this will go, I think you're going to have a lot of the bigger mainstream 401k plans who are going to be like, yeah, I'm not touching this with a 10-foot pole. I'm not going to allow that ability in my plan. I'm assuming that, say, the trustees of the plan will have discretion to allow or not to allow. But let's assume that it forces them to allow. That's where I think it could get a little dicey for the average investor. Purely my opinion. Does that make sense?
Yeah, and I agree. I would hope that if a plan allows these types of investments, that there's some, I don't know, just some mandatory advising from somebody like that they bring in to look at these accounts.
Point.
I just don't see how you can add this to a 401k and then it's like a free-for-all with all your plan participants. Because like you were saying earlier, what if somebody is a year or two from retirement and then they add something like this and they had no idea?
Yeah. I mean, I'm going to give it to you on a smaller level that I see there. And I want to be careful because I can't name company names. So it's very common that there is one money manager, I'll call it, out there that has something called a fixed account that is offered in the retirement plan. And this fixed account has what is perceived to be, when you look at the numbers, well, the interest rate on this is more than the money market option or the stable value fund, so I'm going to do that. And the institution issuing that fixed account, they're the ones on the hook for the investment risk. So what happens, though, is when a participant retires, the perception is, oh, well, I can just move 100% of that money or access it. And in the example I'm thinking about, the last I heard, they only allow access of 1/10 of that fixed account balance per year. So if you retire next year, you only get, let's say you have all of it in the fixed account, $1 million. The year you retire, the most you can touch is $100,000. That's an issue for me. And I just think that that's an example of areas that I just don't think get enough, scrutiny or education. That might be kind of a hot take. So again, I am concerned when I see these types of things. And I think it's going to be more used on, say a solo 401k, or maybe a company that has, 5 or 6 staff members. And if the trustees are comfortable, allowing such a thing, it's going to have to be papered from a compliance perspective. It's just a lot of risk here, right?
Yeah, you would think
on
that
multiple levels.
Yeah, you'd think that there'd have to be a lot of parameters if this is enforced. I know there were a couple comments on the YS website that said things are going to be in review for about 180 days. So I don't think that this is something happening anytime soon.
Yeah. Mm-hmm. The other thing that comes to mind is we got to realize that in these, 401ks, there needs to be an annual valuation on these assets, right? So it makes me think about when you're in an IRA, it's the same thing. Well, I've seen clients go out and hire a specialty custodian that allows them to invest in like physical real estate. The cost associated with it, because at the end of every year, and you know this better than me, Taylor, with you being a CFP, you need to have a valuation year-end balance on that retirement account, on that IRA. And if it's invested in a third-party illiquid, physical piece of real estate, you're having to go out and pay for an appraisal every single year. And then once people start adding up the cost structure just to administer these private investments in a retirement account, oh my gosh, for me, it becomes relatively cost prohibitive, right?
More work than it's probably worth.
Exactly. I'm glad you brought this up. So here's what I would love to hold you to. When you do hear more updates, make sure you bring it back onto the podcast to be fun, and try to pick a week where I'm here. I'd love to have this roundtable with you again on the topic once we get some guidance.
Yeah. I'll wait for more updates, and hopefully they give out some dates, at some point with this.
Yeah. And who knows? Maybe they might come out with some guardrails that make me comfortable with it. Who knows? But on the initial glance, I got some reservations. That's how I'd react to that.
Yeah, me too.
Sound good? Anything you want to leave listeners and viewers with?
I don't think so. A little bit slower in the market right now.
Yeah, kind of got that late summer lull, kind of feels like. I'm okay with it. I think that when it comes to market headlines, you tend to have a slower flow after the earnings season from that second week of July to roughly the first week or so of August. The news flow just tends to slow down. And I think that it'll start picking up again with the Fed, and especially on that next Federal Reserve meeting announcement date in the middle of September. I'm assuming things will heat up again, if that makes sense. Well, thank you for listening to episode 315 of the Independent Advisors Podcast. Myself, Taylor, Mark, Jenna, Nick, Aaron, we all thank you for listening and look forward to catching you next week. Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of The Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.